everyone, welcome to the Momentum Lab channel. In this week's video, we will be covering the top 5 momentum-based small cases for the month of July 2024. For existing subscribers, you may know that we have been doing this series for the last 3 months, and this is the third in a row of such videos. So in this video, we will be covering all of the momentum-based small cases, ranking them based on a few parameters, and also understanding how we are doing this ranking, and finally arrive at the top 5 momentum-based small cases. Now, before I jump into the video, let me give a small disclaimer that we are not SEBI registered advisors, and any information provided to you via this video is to be treated only as educational content, and any advice that you might want to seek about your investments should be through your own financial advisors. Now, without further ado, let's get into the video. So most of you who have been investing, if you have been investing, must have heard about small cases. They are another popular channel of investments, just like ETFs or mutual funds. And even small cases offer you momentum-based funds to invest in. However, unlike for mutual funds or ETFs, the tools or instruments that are available to analyze each and every small case to find out which one is doing better do not exist. So considering this gap that a comprehensive tool does not exist, we at Momentum Lab are bringing you these in-depth detailed videos on top momentum small cases, where we discuss how we rank the small cases and how we do arrive at the top 5 small cases and what are the various parameters one should keep in mind when they are selecting the small cases. So before getting into the video, the most rudimentary or the most fundamental question one might ask is, why do we need to analyze small cases just like mutual funds? Because aren't they straightforward? One can directly go to the small case website, look at the returns that they are providing for 1 year or 3 years or 5 years or the maximum time period, therefore, and choose the one with the highest return. Yes, of course, that logically looks like the right way to go. But however, there are several reasons why one must also take in-depth analysis or conduct in-depth analysis of a small case or small cases and compare them with each other before they take a call. Like we keep saying, every investor's needs are different, and this especially gives us the reason also as to why and how much and where we have to invest. Now, let me give an example, detailed example of why we have to analyze small cases and what are the different parameters or factors which affect the returns of a small case. So for the purpose of it, let us consider one example, one small case, a momentum-based small case over here. I'm on the SmallCase website and I'm here at the fund that I'm using to provide you as an example. Another disclaimer is that this is a very random choice. In fact, you will see that this small case is one of the top 5, and we are not against any small case, or it is not to show that, show this particular small case in a negative fashion. In fact, we're just randomly using one of the small cases as an example. Now, going into the explanation, let's just say that this XYZ small momentum-based small case exists. And if we look at it, we have a 3-year CAGR as 39.57%, right? However, it's not all that straightforward, because just like mutual funds, even small cases have a lot of transaction costs. If you have already invested in mutual funds before, you will know that there is something called as an expense ratio. It talks about a lot of costs associated, how much that do you need to pay if you need to come out of it before a set time, etc. So just like expense ratios for mutual funds, we do have some hidden costs and transaction costs and fees for small cases. So how do I find that? If 39.59 is not the exact return, how do I find the net return after all of the costs? Again, I want you to understand that 39.59% 3-year CAGR is of course correct, but we are also looking at the net returns. Now, for that, you just need to scroll down to the particular scroll down in the page of the small case and look at understand small case costs and returns. Every small case page will have this particular thing, and one has to go into detail. Now, let's just click on view costs and returns, and then you will find that a cost adjusted CAGR is somewhere for this fund at around 27.59, right? Here we look at a 39.59, and here we have something called as 27.59. Now, what are the different costs that may occur, and why, and what should I be looking out for? So over the right, again, it is pretty much almost everything is given to you. All the information is provided to you. It's in the open, and it's just an exercise for us to go and look at it. Subscription fees is one of the biggest costs that are associated when we buy small cases, momentum-based small cases, or any small cases for that matter. You do pay a fees to the manager who manages your fund, and that is a subscription fees. So there is a subscription fees, and there are also transaction charges. What are these transaction charges? The transaction charges are similar for any other equity instrument that you're investing in, and these simply translate into the charges that you pay to the platform. For example, in this case, SmallCase is provided by Zerodha, and when you make transactions, there is something called as rebalancing, right? When we rebalance our small cases as well. So when we do such transactions with respect to our portfolio, we incur charges, platform charges. So those translate into the transaction charges. These fees and transactions together also affect how much of a profit or how much of an annualized return that we are making. Now, the second other thing that might affect or that will affect your return is the amount that you will be investing. Over here, the example that is provided on the page for us is considering a total investment of 1 lakh rupees, right? When we are investing 1 lakh with a subscription fee and transaction charges, it totals to 1,35,985. And if this is the total investment, and the returns would be this, and therefore that comes somewhere around 27.59%. Now let's try and edit this a little bit. Let's just say I want to take 10 lakhs. It's just easier. 10 lakhs is just an easier amount for me to calculate over here. So I'm applying the changes and let's see what it has to say. Right. Here it is in front of you. And if I consider 10 lakhs as my investment, as my minimum investment over here, the subscription fee, mind you, remains the same. Yeah, here are the returns. So I'm considering 10 lakhs as my minimum investment in this small case. Now, if you come here and look at the annualized returns, it's at 38.87. That is quite high from 27, around 27 to 28% that we saw when we looked at just 1 lakh as our investment amount. So what changed? What changes is that when you put a higher amount, you're still paying the same kind of subscription fee, right? So your fees does not proportionately increase with the amount. The fees remains. And also transaction costs, of course, vary because you have higher investment, but they're also almost at a lower rate. So considering all of this, right now, you are having a lot of your amount, a lot of your 10 lakh capital that is going in the investment, and therefore higher the amount that you invest, higher the returns that you see. So the amount of investment also matters when, we are understanding the kind of returns a particular small case has to provide. The third other important parameter that we will be looking at is the time frame. So the amount of returns that one sees either through mutual funds, through equities, or through small cases, ETFs, etc., all vary through the time. You would be agreeing if you have been in the market even at least for a month's time, right? So when I look at the returns for a particular small case for 1 month, the returns might be somewhere like this. And for 6 months, again, the returns change. For 1 year, the returns are different. And for 3 years, again, the returns are different. So how do I find out which time period is good for me? How do I understand which time period should I consider while understanding the returns of a particular momentum-based small case? So here what we have is that, as you can see, that time in the market is more important than timing the market. Even if you're a novice investor, if you're a veteran investor, whatever the stage at which you may be, most of you, if you've at least been in the market for 1 month, you will agree that, timing the market is extremely difficult. Therefore, we must rely on time in the market rather than timing the market. Now, having said that, what is the time period that we should choose when we are trying to analyze the small case returns? In this chart, there are 3 different time periods in which we are looking at returns, right? These are annualized rolling returns, and the periods that have been considered over here are 1 year, 3 year, and 5 years. So in the 1 year, you will see that the returns are ranging somewhere below -20% to above 60%. The range is really high. So you might either end up getting -20% returns, or you might end up getting 70% returns. Okay, that is a huge range. However, when you look at a 3 years time period, you can see immediately through your naked eye that returns are stabilizing. The range is also becoming smaller. It is somewhere between 0 to 40, 42, somewhere like that. We're not seeing any negative returns in this period, and we also see that the top is not very high in comparison to 1 year. Now, coming to 5 years, we can see that the minimum is is not hitting zero at all. So it's way above zero. And the topmost returns are somewhere in between, 30 to 35%. So though the value of the range is really small in 5 years and slightly smaller in 3 years in comparison to 1 year, you can see that the returns have stabilized. So sometimes what may happen is that when we are looking at an investment only for a 1 year duration, it just might be luck. Sometimes you might have a very good luck and have great returns at around 50, 60 to 70%. Sometimes it may not be you may not be very lucky and you might see negative returns, and that too in negative 20s, higher 20s. So we do not consider 1 year as a very good ideal time period for us to make a decision. Therefore, anywhere between 3 to 5 years is a great time to look at your small cases and make a particular decision. Now, for this exercise, we have considered 3 years as our returns, because when I take you through the list of small cases, you will understand that there have been several momentum small cases which have not touched the 3 year period even. And when we consider 5 years period, there are around maybe 1 or 2, maybe 3 that have touched the 5 years. So we will, by considering 5 years, we'll be reducing the basket really small. So just to have a good healthy amount of small cases that we can compare, we have picked 3 years as the time period where we will be comparing the small case, momentum based small cases. So now we have established that there are a few parameters that are very important when we consider the comparison of momentum based small cases. One is that we have to consider the amount of money that we are going to bring in as investment when we are putting in a small case. The second thing is that we also have to consider the kind of time we have in the market, right? We also have to understand and be aware of the kind of time we are willing to spend in the market invested in a particular small case. Now, there are also costs and transactions and fees, platform costs, etc., that I have spoken about. That is another important thing that one must consider when they're looking at the returns of small case. There are two other parameters, two other sub-parameters of one major parameter, which also needs to be considered while considering the returns that a small case provides. That is nothing but the benchmark returns. So how does your small case perform in comparison to a benchmark return? Now, what do I mean by a benchmark return? So benchmark return is nothing but, it could be Nifty 50, it could be Nifty Next 50, and there's also one benchmark specifically focusing on momentum. It is Nifty 200 Momentum 30. So we have to do this comparison because essentially by investing in a small case and not investing in a particular index, you are taking additional risk, right? So if your small case, the small case that you choose, is not even giving you the returns that an index gives you. So whatever index you choose, if it is not giving you a return more than that index, then one need not go through this entire process of finding a small case to invest in, paying a subscription fees for it, and investing in it, right? So therefore, the returns of a benchmark, comparable benchmarks, also become extremely important when we are trying to understand the returns of a particular small case. So there are two benchmark indices that we usually consider. One is of Nifty 200 Momentum 30. That benchmark, we have been taking proxy of UTI Nifty 200 Momentum 30 index, and we also have the Nippon Nifty 50Bs. So this is also a proxy for Nifty 50 index. Now we are also going to see that the select small cases or more select momentum based small cases are beating both or are beating either of this. I will take you through in detail when I speak about the methodology, but for now we just have to understand that our momentum based small cases also have to beat these two indices. Now, to understand the methodology of exactly how we have done this analysis for small case momentum based small case strategies, this in front of you, it is a 5-step process that we follow for ranking it. The first and foremost is basically to select a list of all the small case strategies, momentum based small case strategies that are available to us in the small case website. And the next one is to shortlist those which are running for more than 3 years. So we have already established why we are considering the 3-year framework. So we need the momentum small cases to have at least completed 3 years in the market. Only those are we going to consider shortlist for ranking. Now, at the third level, we want to consider the return of the particular small case has to beat at least the Nifty 50 index over the last 3 years. So we will also be considering and comparing the CAGR of the last 3 years with the last 3 years CAGR of Nifty 50 index. Now, and then we will be eliminating all of those momentum strategies which are not meeting the Nifty 50 benchmark, right? As the next step, what we will be doing is we'll also be picking the ones which outperform the CAGR of Nifty 200 momentum 30. I've also shown you that as a different benchmark, and we also need our small case momentum strategies to outperform. Their CAGR has to outperform this particular benchmark. The last and other important parameter is the Sharpe ratio, and I will take you through what the Sharpe ratio is, how do we calculate, and why are we considering this in the later part of the video. Now, for the first 4 steps, let me show you the list of what are existing and what are the particular returns in comparison to the benchmarks. So here is a list that you are able to see in front of you. Before I get into the list, we have a Nifty 200 momentum 30 benchmark at 25.93% and Nifty 50Bs at 14.38%. There are around 40 momentum-based small cases that are being offered, of which we only have 17 strategies that have completed at least 3 years. For the next month, I think we will be seeing an addition of 3 more funds, but for now, we just have a list of 17 funds. Just to detail out what are these colors about, etc. We have the manager over here, the manager who's offering the small case, and the name of the small case that's being offered. We have the start date. We also have a 3-year CAGR, and we have a Sharpe ratio, and we also have the time period over here. So coming to the time column, everything that is marked in green has completed at least 3 years, right? So we are not bothered about the returns or the Sharpe ratios, etc. for any strategy that has not completed 3 years. Now, out of these, we have funds marked in red which have not at all beaten any of the index. Either of the index they have not beaten. So they are below Nifty Bs as well over here. And the next ones in yellow that you see are the funds which have beaten the Nippon Nifty 50 Bs but have not been able to beat the momentum benchmark index. And the ones in green that you're seeing here are the ones which have beaten both the Nifty 50 Bs and the Nifty 200 momentum 30. You will see that there are about 9 funds which were able to beat the momentum index benchmark this time. There are 4, 5, 6 of them which were able to beat only the Nifty 50, and we have 2 which have not been able to beat either. Now, you will see that there is something called a Sharpe ratio that I've been using over here, and I've also spoken about in the methodology. Now, what is the Sharpe ratio and why do we need to consider it? Let me explain it to you. Now, Sharpe ratio is the excess returns that you get when you take some excess risk, right? So, for example, let's just say that you have invested in risk-free instruments such as fixed deposits or government bonds, etc., which give you a return of around 6%. And you have now taken your money from these risk-free instruments and have put in different instruments. And in the new instruments where you have parked your money, you are getting a return of let's say 9%, right? Now you are getting an excess return of 3% over here. So if you would have put your money in fixed deposit, you would have gotten a 6% return. Now that you're not putting in it and putting it somewhere else, you are getting a return of 9%. So there is an excess return of 3%. And to get this excess return, you are also taking some risk. What is this risk? This risk could be the time and effort that you put to identify the instrument. It can be the exposure to equities or market, etc. The fluctuations, volatilities, etc. So whatever may be the risk, you are putting a certain amount of risk to get these excess returns. So essentially, what will make sense is that when you are taking this additional risk, your returns have to be meaningful so that you consider this other instrument as better than the instruments which are risk-free. So how do you understand this? How do you understand if your risk is worth it? It is through the Sharpe ratio. Now, simply put, let's say that the risk is calculated through standard deviation. And standard deviation for this particular case is around 10%. So essentially, the risk ranges somewhere between -10 to 10%, right? Plus 10%. So for an excess return of 3%, you are taking a risk of 10%. So 3 divided by 10 is your Sharpe ratio, and that would be somewhere around 0.3. Now, simply, just to put it simply, if the Sharpe ratio is lower than 1, the amount of risk you are taking for the return that you are getting does not make sense. So one is an equal risk, equal return sort of a scenario. So anything that if you're getting any value which is below one, so it is simply can be understood as that the Sharpe ratios don't make sense to you. The risk you're putting in is not giving you equal, enough, or greater reward. So we even when we consider the returns or the 3-year CAGR of all of the small cases, we also look at the Sharpe ratios that they have, and these Sharpe ratios also help us in ranking all of the small cases. So, for example, we have a small case which has 40% return, but it has a Sharpe ratio of 0.5%, and there's another small case which has around 39%, but has around 2.5 Sharpe ratio. Naturally, the latter or the second investment where we have 39% return but a 2.5 Sharpe ratio will be ranked higher than the 40% return which has only a 0.5% Sharpe ratio. So now that we have established all of our rules or the ranking methodology that we use, let us look at what the month of July has to offer. So in July, we have around 9 small cases which have beat the Nifty 200 momentum index, and you'll also see that the returns and the Sharpe ratios are varying heavily. So this month the ranking has become a little difficult because some of the funds that are performing that are having really good Sharpe ratios of over 2 also have some slightly lesser returns, and so on and so forth. Here is the final list of the top 5 momentum small cases for the month of July. This is a series of this is a monthly series, and we will continue to carry out this analysis and bring out the top 5 momentum small cases to you each and every month. Thank you once again for joining the Momentum Lab, and see you in the next video. Thank you.